Coffee Can Investing, Book Summary in English, by Saurabh Mukherjea Kaur. Idea of Coffee Can Investing. The concept of coffee can investing was introduced by Robert Kirby. The idea is simple. Pick 15 to 20 fundamentally strong stocks. Invest in them and forget about them for at least 10 years. This long-term strategy helps you leverage the power of compounding and reduces risk from market volatility. 2. Key questions to ask before investing. Which stock should I buy? How long should I hold it? Key investment lessons. 1. Don't follow the crowd. Copying others in investing, like friends or social media tips, often leads to losses. You must invest based on research and your own financial goals. Invest in the stock market, not just property or gold. Real estate and gold are often assumed to be safe investments, but returns are usually low or risky. Fixed deposits, FDs, are safe, but often don't beat inflation. The stock market, historically, has delivered the best returns over the long term, around 15% plus per annum. How to build a coffee can portfolio, CCP. Stock selection criteria. Market capitalization. Companies must have a market cap of over 100 crores. Return on capital employed, ROCE, must be above 15% consistently over the last 10 years. Annual revenue growth, at least 10% annual growth over the last 10 years. Avoid high-debt companies. Companies that rely heavily on borrowing often struggle to sustain profits. Prefer B2C companies, businesses that sell directly to consumers, like FMCG, banking, retail, are more stable than B2B companies. Look for companies with strategic assets. These include intellectual property, patents, brand value, and strong company culture. Why coffee can investing works. Low transaction costs. Fewer trades mean lower brokerage and tax costs. Tax efficiency. Long-term capital gains are taxed favorably in most jurisdictions. Compounding magic, staying invested for 10 plus years allows exponential returns due to compounding. Stable long-term gains. Historical data, 2000-2017, shows a CCP gave 24-25% average annual returns. Risk management. Diversify across sectors and companies. Monitor company performance occasionally, but avoid frequent trading. Investment strategy should match your age, risk tolerance, and life stage. Psychological insight. Loss aversion. People feel losses more strongly than equivalent gains. Holding stocks long-term